The single biggest mistake investors make with major video game releases is buying the stock on launch day. If you buy the stock when the game drops, you are already too late. The smart money buys the rumor and sells the fact. With Grand Theft Auto 6 officially locked in for November 2026, the countdown clock is ticking. Billions of dollars will flood the entertainment industry in a matter of days. But the real wealth will not be made by the people playing the game. It will be made by the strategic investors who position themselves before the hype peaks. If you miss this window, you miss the biggest entertainment super cycle of the decade. Today, we break down the exact stock market blueprint to profit from this historic release. To understand where the money is going, we must first look at where it went. Let us travel back to September 2013, when Grand Theft Auto 5 hit the shelves. Most people look at the historic $800 million in first-day retail sales, but they completely miss what happened to the stock of the parent company. Take-Two Interactive. In the 2 years leading up to the launch, the stock practically doubled as anticipation built. When the game finally launched to record-breaking numbers, a fascinating pattern emerged. The stock did not immediately rocket to the moon. Instead, it experienced a temporary pullback as early investors locked in their profits. But what most people do not know is what happened next. Over the next 5 years, the steady stream of microtransactions from the online mode drove the stock up by over 1,000%. The initial launch was just the spark, but the long-term ecosystem was the real money printer. We can use this exact historical data to map out the current opportunity for Grand Theft Auto 6. Take-Two Interactive trades under the ticker TTWO and currently sits around $250 per share. Wall Street analysts are already modeling up to $1 billion in revenue within the very first hour of release. The company itself has projected record bookings of over $8 billion for the upcoming fiscal year. This represents a massive surge from their baseline earnings. The stock has recently seen sharp, volatile swings, pulling back to the $210 range before climbing back up. This volatility is a gift for disciplined investors. Buying during these pre-launch dips provides a massive margin of safety. The closer we get to November, the tighter the supply of shares will become as institutional funds build their positions. The surprising part comes next, because the primary game developer is only half of the equation. A game of this magnitude requires immense processing power, which brings us directly to the hardware giants. Sony and Microsoft are entering a massive upgrade cycle, specifically timed for this release. Rumors and early marketing point to console bundles, designed to maximize the graphical performance of the game. Sony, trading under the ticker Sony, stands to benefit immensely due to its dominant market share in the console space. When a gamer buys a new console just to play one title, Sony wins twice. They profit on the hardware sale, and they take a 30% cut of every digital purchase through their store. If you want a diversified way to play this launch without betting entirely on a software developer, the infrastructure providers offer a much safer floor. Before you skip to the end, we need to talk about the hidden winners that no one is mentioning. Hit that subscribe button right now to stay updated on these weekly market-moving trends. The biggest structural shift between 2013 and today is the death of physical media. Reports indicate that Grand Theft Auto 6 will launch with heavy emphasis on digital-only delivery. This completely changes the profit margins for the entire supply chain. It removes the cost of manufacturing plastic discs, shipping boxes, and sharing revenue with brick-and-mortar retail stores. This extra margin goes straight back to the publisher and the digital distribution platforms. But thousands of gigabytes of data downloading simultaneously across the globe will put unprecedented strain on internet infrastructure. This creates a massive tailwind for content delivery networks and cloud computing providers, like Microsoft Azure and Amazon Web Services. These enterprise giants will see a measurable spike in data usage, data fees that will show up directly in their quarterly earnings reports. So, What is the actionable game plan for your portfolio today? Do not chase the stock when the trailers drop and the internet goes crazy. Look for price consolidation in Take-Two Interactive over the next few weeks to accumulate your position. Consider balancing that high upside play with a steady giant like Sony to capture the hardware upgrade cycle. The window to buy these stocks at a reasonable price is closing fast, as the market prices in the November revenue. Make sure to watch our next video, breaking down the unexpected commodity squeeze happening in the markets today. See you in the next one.